Student housing is such a unique industry. The more unique an industry is, the more important it is for that industry to have a resource and a platform to share ideas and data, to determine best practices, and a platform to simply promote networking among the professionals in that industry. That's what we are setting out to provide with Student Housing Insight. But what's even more unique about the student housing industry is how unique the professionals are. They want to make a positive impact on the students and the university communities they serve. They understand they have an opportunity to touch the future. They come to work every day looking for ways to make that future bright. If you're one of those people, come be a part of Student Housing Insight. Hello, everyone, and welcome to Shop Talk. If you can, just in the chat, just if you can make sure that just someone tell me that you can hear me. I want to make sure everything is good with our audio. All right. Thanks, Nick. I appreciate that. All right, guys, welcome to Shop Talk for November. Got a couple of housekeeping things I want to go through really quick in case this is your first time being here. Give me just a second. I'll start that presentation. So let me navigate things a little bit for you here because we are using Webinar Jam, which is not a platform that too many people are used to, but it does work similar to any other webinar platform you've used before. But want to make sure that we're making this as interactive as possible. And so I really encourage you guys to use the chat widget over to the right-hand side of the screen. Just click on the chat up at the top, and then down at the bottom, you can choose who will actually see your chat. So if you want everybody to see it, or if you need it to be just to myself as the host. If you've got questions, and we've got a lot of folks that have got a wealth of knowledge that they're bringing onto our panels today. If you've got questions for them that you would like for me to ask them, ask you to put it in this Q&A section in that same chat widget. Also, if you would like to come onto the virtual stage and actually have a conversation with the panel, you could do that as well. Just hit the request to speak button up at the top end of that widget. If you do that, you'll go through a couple of items, just a sound check and video check. So get used to that. And once you get past that, you'll be on the live stage with us. Well, guys, as we always want to start out with Shop Talk, we want to get our legislation and policy updates from NMHC. David, how are you doing?
I'm doing great, Wes. Again, always look forward to this informative meeting, and so I'm happy to provide a little bit of an update from Washington, D.C.'s view.
Yeah, we didn't get to the hurricane rained on us.
Don't remind me.
It's
a lot of drinks to forget. So
I'm sure.
Yeah.
But did hear that you guys had a fantastic OpTech last week in Las Vegas. So congratulations on that. I've heard a lot of good things. A lot of good meetings that came out of it. So thanks so much for putting that on for the industry at large. And last month you guys were busy with other stuff. So we didn't have an update in October. So I know you've got a lot to catch up on here.
Yeah. So, look, if maybe you had your head in the sand or something, but, oh, by the way, there was an election this week. And certainly if you are interested, you probably have read a lot of things. What I really wanted to do was cover what does the election mean for student housing specifically? There's an awful lot of commonality between multifamily market rate and student housing. So a lot of things that would impact the conventional side will certainly do that on the student housing side. So, what we're looking, we had it before. We had a very narrow margins, both in the House and the Senate. It looks like that's what we're heading to again. So the question becomes, from a big legislative perspective, what if anything can happen? Nothing's going to happen before the end of the year. There's a couple of things having to fund the government, those types of things, which have implications, but nothing that would be too meaningful for the overall industry. So lame duck is in fact going to be a lame duck this year. Don't expect a lot of things to happen. We're not going to know the outcome of the Senate until likely December 6th. It could possibly, depending on what happens in Arizona, turn into a 50-50 even before, or a 51-49 even before we get the December 6th runoff in Georgia. So the outcome there is, what happens next year. And if you think about what we've talked about up until this time, a lot of it was regulatory behavior, and we think a lot of that will happen again. We think that the administration will try and move some of their agenda forward, and we don't expect anything different next year because you're going to be divided. For all intents and purposes, it hasn't been called yet, but the view is at minimum you're going to have a Republican-controlled House. Senate is up in the air. We all know what the White House is. So what can the White House move forward on? And it certainly looks like it's going to be more regulatory behavior. And so let me cover some of that, because some of those do have impacts on student housing. So for instance, FHFA, which is the regulator of Fannie and Freddie, and clearly Fannie and Freddie have been a big provider of capital for the industry for many years, have changed how they count affordable housing and have raised the bar for the enterprises in terms of how much they need to do. The implication there is that you're going to see the enterprises even more focused on, let's call it affordable. And I'm not talking about super low, but 60 to 80% of area median income, which is always a challenge for the student housing industry. So there may be a little bit more of a challenge for our industry to continue to get the complete flow of capital from the enterprises. We don't know that, but there's certainly some implications there. And then they will issue what's called their scorecard next week, which again kind of dictates what the expectations are for the enterprises in 2023. So we'll wait and see. That puts a production cap on them. This year they had $78 billion each that they could do. But quite honestly, because of the affordable housing goals they have right now, they're not even going to reach their cap. They may get close, but I doubt they're going to reach that. Some other things that may be interesting for the student housing industry. Earlier this year, the Inflation Reduction Act, I don't think we talked about this since we haven't been on this call for a while. There's some interesting energy provisions that could be beneficial to the student housing industry, both from energy retrofits on existing buildings, and certainly there's some really good provisions there. So if people are thinking about putting, whether it's solar or some other type of energy, green energy products on their buildings, this is certainly something I would encourage you all to look at, because there's certainly a significant amount of money available there. In addition, there's some money for EV charging stations, which I don't really have a good sense on the student housing front. I know my daughter's at Clemson. I don't see any of her classmates driving electric vehicles, so it may or may not have an impact. And there's some other geographic and restrictions on that, but it's at least something that people should take a look at. So speaking of kind of regulatory White House focus, et cetera, the White House has been exceedingly focused on housing in general, affordable housing. And again, while this may have a smaller impact on the student housing sector, there are certainly some provisions there that are pushing forward that may be impactful, and some of them have to do with some EV related incentives, have to do with FHFA having more flexibility on doing takeout of construction loans, which again, certainly are something that our industry focuses on as well. And then just this week, to give you a sense, we were invited to a White House hearing with a number of other trade associations and others on Monday to Tuesday to talk about how people operate their properties. And the White House is very focused on residents. And so, that certainly could have a student housing type of overlay. And so, let's call it tenant protections could be built into loans that the industry gets from Fannie and Freddie. So people need to be aware of that. These are things that we're focused on. And then we're going to another White House hearing next week, which includes some discussion around affordability. And what I mean by that is, they're getting pressure from a lot of advocates regarding rent control in some fashion. There are even some advocates who are out there pushing the White House to ask FHFA to put rent control provisions on every Fannie and Freddie loan that gets originated. So again, given that there's a big financer for student housing, there could be implications for our industry as well. We don't think that's going to happen. Last year, I would have said the chance of that is 0, but it's bigger than 0, but still a small number. But clearly, this is very much in play. And so we're just letting people know that there's some potentially ugly trickle-down impacts of some of the stuff they're focused on. And the last thing, which is, and I'm not going to get into the details, but there are a number of rent control provisions in certain cities and modifications of how much you can increase rents. And the reason we bring that up is because they may be in certain cities where our industry has a housing for students that would be impacted by this as well. It doesn't, it's still multifamily, even though it's student, the rent control would limit the amount of increases you could do on your properties. What they look like, age of properties, et cetera. I don't want to get into details. We do have some of that information on our website, and certainly would encourage people to go to our website to look at that to see if they are, may be impacted by some of the provisions that are out there. With that, I'm going to turn it back over to you and let some of the market detail and others jump on the call. So appreciate the opportunity to always participate, Wes, and happy to answer questions now or at the end if you'd like to.
Yeah, fantastic. I don't see anything in the Q&A yet. Actually, we got something from Will Baker here, and he's about to jump onto this panel as well. But he says, with the increased focus on affordability by FHFA on the scorecards, have there been any discussions with the regulator about, sorry, my screen's too far away, about defining affordability with the student housing industry?
It's something we've raised with them. It's something that we will work more with them. They've been a little resident to spend much time on it, and so it is something that they've gotten a lot behind them of new things that they're working on. So I think there's an opportunity for us to talk further about that. But the ultimate challenge always is the definition of what the income is on properties to help them qualify, whether it's student, whether it's parent, et cetera. And so that's always a challenge on student housing.
Will, I don't know if you heard that, but I did ask Dave your question there. You may have been.
I was joining the room right as he began the response. I can follow up with Dave after the webinar here.
Well, fantastic. Well, again, if anyone has any questions, Dave will be around a little bit. If you want to put them in the Q&A, and I can send them over to him and try to get an answer here or send out an answer later. But David, thanks so much. We'll talk to you. All right, guys. Let me make a couple changes here. David, for some reason, it's not letting me kick you out, so you may just want to kick yourself out. Well, guys, as most of our attendees and our audience probably knows, this is the time that we start going over last month's pre-leasing summary provided by CollegeHouse. And this month, we decided to do something a little bit different. Charlie's done a couple of webinars in the past few months where he's had a panel, come on board and kind of talk about what the data is telling those folks from their different perspectives. So
we kind of wanted to bring a little bit of that to what we're doing here at ShopTalk, and I'm pretty excited about this. Maybe we'll do it every month. Maybe we'll do this once a quarter with this format. So if you like it, let us know. But want to go through really quick, Charlie, before we introduce the panel, and see if you've got any announcements. I know your next version is coming out pretty soon.
Yes, Wes. Thanks for, as always, getting things together for Shop Talk. But yes, it's been a labor of love this week, getting together our version 3 release, which will go out Monday or Tuesday. Be on the lookout for an email from us. Countless new things, which is exciting. Now that we've eclipsed such a high level of buying from the industry. So bringing all that good stuff to you in a much cleaner, better way. It's always going to continue to innovate and build off this model with a lot of new things coming. So if you're a client of ours, want to learn more, feel free to reach out. But I have some information coming to you early next week. So very excited. But other than that, we're getting rocking and rolling here. I know, excited to talk with the panel here. It's interesting. Wes, we were talking about what's a different topic that we can kind of bring into discussion. We know that for the sake of the macro world, interest rates are flying all over the place. Inflation, CPI index, I know actually the numbers today.
A weird time, that's for sure.
Weird time for sure. So what we want to do here is make this more conversational, leverage the data in the conversational aspects around the operations, and specifically on the deal making side with Will and Jamie from the lending, sourcing debt, and then also what's it take these days to get a deal done. So
let's get the panel introduced. Jonathan, we'll start with you.
Hi, everybody. My name is Jonathan Bove. I am EVP of Management Services at Landmark Properties.
I am Jamie Swick. I am a student housing professional at Colliers International. I started in the industry in 2000, and I still live in my same little puddle, which is Gainesville, Florida. And if you guys lose me today, it's because I'm currently in the middle of the hurricane. Happy to be here, nonetheless.
We appreciate it, Jamie.
Hi, everyone. Will Baker here with Walker and Dunlop. We're a large Fannie and Freddie lender. Just celebrated our 85th birthday this week. As a matter of fact, I've been with the company for 20 of those years. We have a very large focus on student housing. One of Fannie and Freddie's largest student lenders. Also do student housing financing on the balance sheet bridge side using our own balance sheet. We have our own appraisal evaluation group, Apprise, that does a lot of student housing appraisals, investment sales through Chris Epp and his team, and an alternative investment management that could do preferred equity and some other debt options through Walker Dunlop Investment Services out of our Denver office. But happy to be here.
Fantastic. Jonathan, just to go back to you really quick, for audience members that may not be familiar with Landmark, give us a little bit of detail on size and scope of portfolio. And that
Sure. Landmark is a fully vertically integrated student housing owner operator. We are the largest developer by volume in the space, the largest constructor, largest builder by volume in the space. We manage approximately 91 assets if you include our lease ups. That's about 56,000 students in stabilized properties and several thousand additional prospects coming into our new lease ups. And so we're a top 10 manager by volume, top 10 owner by volume as well. We have done a large number of acquisitions in the last, call it 24 months, which is sort of the most recent addition to our business lines.
Gotcha. And in the BTR space as well.
Yeah, that's true. So we have branched out to include the BTR space, broken ground on a number of deals, and those first beds deliver in July or so of next year.
Fantastic.
Although, we're not intentionally trying to line them up with all of our student housing deliveries. Thankfully, we can spread those out a little bit more than all those August handoffs.
Well, Charlie, let's talk about this first slide here on the leasing performance. And just real quick, does this go through October 31st or the last Friday in October? Got a little bit of context for that.
Yeah, for sure. So this is all as of essentially the last couple of days in October, 28th through the 31st. But what we like to do here is basically give, a full transparency, national view of how things are moving from a leasing perspective. Again, you can see kind of the weighting from a beds perspective, Southeast and Midwest being the highest of the two, or excuse me, Southwest being the highest of the two from a concentration of beds. But I think the general theme across the space is leasing is outstanding. If you're a millennial like myself, it's ripping, for lack of a better word. But Northeast, Midwest, Southwest, Southeast, all up. The Southwest, for example, up almost 12%. Southeast about 11.5%, if you will. The question goes into what does that mean from a rent growth perspective, which we'll jump into on the next side. But one thing that's very interesting, and I know the theme is earlier and earlier every year. I was talking with some clients earlier in the week, and like Knoxville, Tennessee is upwards of 80% already. Rent growth is silly. It's interesting to see how that has changed as we look at like the West Coast, where things don't necessarily start as quick. That's based on the quarter system or schools starting a little later. But for the most part, we're seeing double-digit rent growth and properties upwards of 60+%, and it's 11/10, November 10th. So it'll be interesting to see how that trails or tracks throughout the leasing cycle, where markets, even like West Lafayette, Indiana, Knoxville, Tennessee, Clemson, they're seeing significant jumps early on. What does that mean for those that have a few beds left? Are those rates going up, or is there going to be a kind of a call to action to get those heads on the bed? So I think it's the former, not the latter. But I'd be interested to kind of turn it over to specifically Jonathan. I know Landmark's coast to coast, Seattle down to Miami, all the way up to up in New York. What's the general theme over at Landmark?
I think this year, more than any else, we've found ourselves reevaluating at multiple points in a given day what our adjustments, our rate growth targets are going to be. The process, the system that we have in place for our team triggers conversations with our asset management crew after certain velocity thresholds. And this is aside from every year, you've always got a few assets that just outperform, and there's a particular market idiosyncrasy. This year, rather than those one-off situations, we're finding in multiple markets that we're hitting one or more of those triggers in a week. And as a result of that, having multiple different adjustments. Normally our rate plans have maybe 4 to 6 rate tiers. Some of them are already like we've abandoned the lower tiers and we're already on to tier 8 or tier 9. So certainly some markets, you mentioned Knoxville a minute ago.
Let's talk about that, Jonathan, because that was actually.
I honestly laughed this morning. We had a call with our equity partner there, and they're like, "It's great to see Standard finally at 100%." And I was like, "I just got to tell you, it's the 10th of November, so there's no finally." We have that particular asset performed so well this year that we had genuine conversations about at what point does one hit the brakes on rate growth from a pure PR perspective. So we've had a number of assets. That market in particular, I think, is just dealing with a massively outsized freshman class. And I do think that there are a number of universities that are attempting to kind of recover their books post-COVID. They're increasing their first-year enrollment. They are perhaps seeing higher responses, affirmative responses to those acceptance letters than they would have seen in previous years. And as somebody whose background is in on-campus residence life, I have a master's degree in higher ed. I spent time in enrollment management. It is as much art as it is science. And I think that some of those institutions, they're just seeing outsized affirmative responses and trying to struggle to accommodate all these first-year students that they're getting coming in who, for whatever reason, COVID or otherwise, population changes in their local state, et cetera, seeing some burgeoning class sizes at some of those flagships.
Yeah, I think a lot of it goes back to, they saw the population decline coming for 2025.
we're going to go ahead and start ramping up, accepting more in-state folks. The pandemic put that on, really just put that on steroids. And I'm seeing a lot of students that would have otherwise gone to, UT Chattanooga and not get into Knoxville, but they got that letter, so that's where they're headed. And so,
that's exactly right, Wes. You have a state flagship. Their enrollment is effectively an electrical ground, right? Like they are always just going to have the ability to admit additional students. It's not as volatile as a tertiary school or a community college or a for-profit institution, for that matter. And so, as a result, a little bit of aggressiveness on building that class and ensuring that you've got the right number of acceptance letters that go out can very easily turn into the situation that a number of these schools are seeing if other factors line up. And I think the timing of those factors aligned for a number of campuses in the Southeast in particular this cycle.
So I've got one question for you, Jonathan, before we move to the other folks. Is this early ramp up, is it causing you to retool your marketing budget at all?
It is, but perhaps not in the way that's most obvious. I think certainly for our markets that are several hundred beds ahead of where they were last year, or for the assets, got a handful of assets in Tallahassee, Knoxville that are already 100% pre-leased. But those properties obviously need to get put into what essentially amounts to reputation maintenance mode. We need to do enough in terms of resident outreach to keep our students happy and satisfied. We want to have strong reputations for those assets when we come into next year's leasing cycle. But there's a ton of savings to be found on the marketing and advertising aspects, as long as we obviously want to maintain our websites and their positions and that sort of thing. But the obvious one is there. On the other side of the NOI equation, we're also seeing incredible effective rent growth, even from the already aggressive projections we had coming out of last cycle. We assumed we'd probably match last year's high single digits, but that original projection has grown over 2% in the last, call it 10 weeks since we moved people in and start leasing. We went up 14 basis points on effective rent growth in the last week. So wow. I am particularly curious to see what happens in the run up to the Thanksgiving holiday break. You might assume that given that velocity, that implies like fewer renewals or, the associated rate drag that comes with those renewals. But we have 13 assets out of our 90 that have greater than 40% renewals so far this cycle, which also kind of blows my mind because it's so, I think a lot of students, and particularly in those high velocity markets, are so freaked out by how fast everything's moving that they just want to stay put, when in another market they might instead be out shopping around a little bit.
Gotcha. So Jamie, we've got inflation, we've got interest rates that it seems like it's not going to stop anytime soon. But I'm kind of wondering, when we typically see that, and we have seen it, everything's kind of slowed down as far as transactions are concerned. Is this early velocity, is that overcoming anything, or is it still too early to tell?
Well, I think it's going to give us the wind beneath our wings that we need for the first and second quarter, after we see, knock on wood, but what I predict will be one more rate bump in December from the Fed. So we're going to need that momentum to get buyer comfort and confidence in the first and second quarter in terms of what those pre-leases look like and what that rent roll is going to look like. But, my common sense tells me that a lot of what we're seeing in terms of this velocity and this rush to execute actually is going to tie back to some sensitivity of the parents. So I think that we need to be looking closely at what the socioeconomics are of these originating zip codes, because if we're seeing a lot of housing sales and transactions in the residential segment, I think that there's only a certain amount of time before we are going to feel the clamp on our rent growth as a result of what they're paying in their additional mortgage costs for their single family homes. So I do feel that we're going to find a correlation there. And when that shoe will drop is a little bit hard to say at this point, but in terms of buyer confidence, I think we're going to see that return definitely by March, and we're going to start to see those indications in January.
Okay. So, Will, with the good news about rates going up and then some of these marketing expenses going down, I'm kind of wondering from a lender's perspective on the underwriting, because take Knoxville, for example.
Yeah.
That's kind of happening there 2 years in a row now. Is that enough of a trend for the lenders to see those lower expenses in marketing for an asset that in that specific market? Or
I mean, possibly. It's when it comes to the expenses and look at the marketing and that kind of thing, we typically just look at the trailing 3 years expenses, look at the appraisals numbers, look at the borrower's pro forma, and just kind of come up with some and also our own expense comps in our portfolio, because we've got quite a few to look at as well, and just kind of come up with a reasonable number. So can you get some marginal benefit for a slight reduced one line item on that? Yeah, maybe, but that's not really going to move the needle. The biggest needle obviously is these rent growths. And I've had tons of questions for the last 30, 45 days. Hey, look at these look at Knoxville, 20% rent pop. Can we underwrite that? The answer is no. I mean, you can't with at least with Fannie and Freddie, we're cash flow lenders. So we look at the in-place cash flow, the trailing 3 months of actual cash collections. That's our number. It's great. And we love seeing this rent growth. And come next year, if they want to hold off a year, if they're looking to refinance and take advantage of the next year's rent pop, that's fine. One area to think about. So if you're closing a student housing loan right now in the fall, again, we're going to be on the trailing 3 months of cash collections. However, if you were to come to us, say in March or April, and looking for a refinance or even looking to acquire an asset, then a lot of both Fannie and Freddie can be asking, what is the pre-leasing? So if you're 100% by then, that's great. You can just get it closed then. If you were, say, lagging the market or lagging behind where you were last year, or maybe you're only 50% pre-leased in March, they might tap the brakes and say, we're not so sure. We might want to let you get more leased up before we close on a loan, or put some sort of escrow in place to give lenders some comfort that you're actually going to get to catch up to the market. So just something to think about, but love seeing these numbers. And it's yet another reason why we're still very bullish on the sector. Seeing no issues whatsoever on student housing performance and kind of the top 50 markets that we lend in. The places that were a little bit of concern are just some of the smaller markets, the less than 10,000 enrollment schools, some private schools, some of the Cal State schools, and those kind of places that maybe got hurt a little more during the pandemic. Those are the ones we're keeping a close eye on.
Great. Well, speaking of rates, we can jump into the next slide. Charlie, you want to go over this for us really quick?
Yeah, definitely. I think one of the big trends here, right? Specifically, if you look at Southeast, Midwest, and Southwest, right? You're talking about I wouldn't say a stomachable, because I know a lot of these, like Knoxville, Tennessee, we saw up increases of like $500 per bed on some of these smaller unit types. But again, the theme is a little easier to jump from an average rate of 745 to 784 than it is from 1,026 to 1,062. But the general theme and what we're seeing specifically, I mean, to Jonathan's point on the rate growth, I mean, you're seeing some of these charts look like this, almost hockey stick, which is interesting, because the way that we looked at the cycle last year is, I mean, you get X percent of leases at a certain point, you get X percent of leases at another tier, and tiers up, which is pretty, I guess, intuitive when you look at it from a visualization standpoint on our platform. But I mean, we're seeing rates jump again significantly, where my question kind of comes to Jamie and Will, and I know Will kind of hinted at this. And again, we'll use Knoxville as the common theme. But some of these markets that you're seeing aggressive numbers, not just from an individual from a property level, but as you're talking with investors and as you're talking with these banks and trying to place debt, how much of the conversation is around where do we cap out? Is there a ceiling? Can we really, increase another 5-10% off what these rates are in some of these markets? I know there's some incoming supply in a couple of these that are kind of, what we call into the moon. But give me some insight on kind of what you're seeing and what are those conversations around kind of your outlook looking forward as opposed to, the current.
Yeah, I mean, like I said, I've been doing this for 20 years, probably in student housing for 16. It's clear that this kind of rent escalation is unlike anything that I've ever seen, and any of us may ever see in student housing going forward. So I don't think anyone's projecting these incredible hikes for the foreseeable future. If this were, say, November of 2021, and you came to us for a refinance or an acquisition on a student housing deal, there are quite a few lenders at that time that would project those future higher rent bumps. And a lot of the debt funds, that was the first year that I recall the debt funds actually had over half the market took away from Fannie and Freddie in the student housing perm market. And that in part because they were underwriting so aggressively, looking at future rents, looking at pre-lease rents, looking at buyers pro formas instead of the trailing numbers. So it felt a little 2007, 2006-ish, some of the things, the loans that were done during that time. And, SOFR was nothing. Floating rate debt was cheap. It was 2.25%. And so you could afford to pay a 4.5 cap, and you still get get debt in the low twos. Those days are obviously long gone. So something to think about going forward is some of those 2+1 or 3+1 floating rate deals by debt funds in 2021 start to come up to their extension periods. There may be some opportunities, but there's not real discussions about where it caps out. We're thrilled to see it. Obviously, it's great for the industry as a whole. We're not underwriting that going forward. We're just not. I hope it continues, and I hope these values come up. We're in a little bit of a waiting period on values right now to see what the new rate environment is doing, and that's something Jamie will touch on here. But it's great, but it's not something. There's no discussion about where it caps out. I hope rent growth continues. I obviously don't think it's going to continue at the level it has. I suspect it's going to moderate out here in the next few years, but it's great for the industry.
Yeah. So just to chime in a little bit there on the transaction energies. So Will's exactly right. We are seeing limitations in terms of what our financing terms are coming in, and we're seeing a cap out on the loan values themselves. And so that is a real metric that's playing into the return expectations going forward. Where we're seeing the conservative approach is definitely in that 2024, 2025 rent growth segment. So while buyers are perfectly willing to give you full credit for what you're able to prove out now, are they willing to go ahead and pencil in another 8% growth for 2024? No, they're not. They're just not willing to transact with that level of risk when we're already trying to work through that gap in terms of what the cap rates are for the expectations for the transactions as well. So that's kind of where we're stalling out, if you will.
Yeah, I mean, Charlie, I think there are some buyers willing to, go negative leverage for a year or so, knowing that if you are pre-lease like you are in some of these slides here, that pre-lease, they know they can sort of bear the brunt of going negative for a year, knowing that in September of 23 they'll get back to neutral, and hope in 24 they're back in sort of a positive leverage territory. But it's just a math equation at this point. I mean, debt's a little more expensive, and thankfully it dropped today. The treasuries were down 17 just this morning. So we're.
Yep. Did we lose Will?
Kind of more in the 5.9s, but cap rates are still, at least as far as I can tell, a little below that in most of these major kind of Power 5 markets right now. And so we'll see if that changes in the next 6 months. But like Jamie was saying, I think some buyers are willing to go below that on the debt, take their cap rate below the debt for a while, given these strong pre-leasing and rent growth numbers.
And I know let's just shift this over. So this kind of parlays into this next slide, but as we look at nationally the pre-leasing of the floor plans, and one of the common themes, particularly around the studios and the 6 bedrooms, is more common with newer inventory, if you will, as well as with a cottage product. And Jonathan, I'm going to kind of pick on you again here as it relates to from just kind of like a velocity standpoint. Do you feel, especially with, I guess, a lot of the ground up stuff that y'all are doing over at Landmark, and particularly with the cottage product, that you're seeing a lot more, I wouldn't say price sensitivity, but students more willing to live in the 4, 5s, and 6s to save a buck? And I know Jamie mentioned with, I guess, the macro level with the parents and mortgages increasing. Just kind of trying to get your 2 cents on, again, what's the differences you see between the two? I know it's kind of beating a dead horse at this point as we talk about.
Yeah, Charlie, I don't know that I'd say we're seeing more, right? I mean, I think that naturally a 6-bedroom floor plan tends to have, unless it's a VIP unit, tends to have the lower rate by bed relative to the rest of a given unit mix. And generally speaking, although not universally, those larger floor plans do tend to be more prevalent at our cottage products than our pedestrian products. But I think so that is obviously going to attract a value sensitive student. The other groups that are obviously attracted to those higher bed count units are your fraternities and sororities and other folks that, by virtue of whatever group they're in, show up with a bunch of roommates. So we tend to have a unit mix that includes both the lower priced high bed count units and a couple of VIP options or higher end options as well for the student who might be price insensitive but still wants to live with a large group of friends.
Yeah, that's it. And Jamie, especially with a lot of these, and I saw there was a couple of deals that y'all have closed here recently. What has really been kind of the driver as you're looking at, I wouldn't say affordability, and again, I don't want to put a doom and gloom thing out here, but as it relates to some of these tier ones, the Tucsons, the Tempes, the Clemsons of the world, what's really driving the interest? Is it product? Is it location? Is it, the university itself? I'm trying to better understand fundamentally what's the key thing, because as we look at the industry as a whole, the sector is doing well, but from an asset perspective, and I know y'all have circled the wagon on a handful of deals that are different product types and locations, whatnot. What has really been the driver there?
It's the supply and demand metrics, and it is always going to come back to that. The minutia is going to be kind of what I was alluding to before, which is your places of origin for your parents and their socioeconomic sensitivities. But at the end of the day, real estate is and always will be governed by supply and demand metrics. Now, where people need to be paying close attention is to the asset classes within those markets. So you can't just take a broad stroke brush and say everybody in this market is going to perform in this way. That would be reckless and candidly just grossly inaccurate, because you're going to see completely different metrics at each of those asset classes. It's not going to be completely consistent even within the market. And it also depends on what you're doing in terms of value add opportunities. We've seen groups come in and buy properties that are only 3 and 4 years old, but their approach is that that's a value add opportunity because they know they're bringing in a level of sophistication that wasn't present on the asset before. So that's still being underwritten as a value add from the buyer's perspective. So I wish I could give you a little more specific answer there, but I think you probably knew you were going to hear that, Charlie.
I know. I just wanted to hear someone else say it too. So that's and
happy to help.
I know, and I know we're running close up to this next panel here. Will, one last quick question for you, as it relates to I know a lot of this is based on the operations side. What are some of the key operational attributes, or I guess tricks of the trade, that you've seen have been favorable when talking with lenders as it relates to items or decreases in levels? I know we're talking about hiring here on this next panel, but from a line item perspective, what is most important that you've been seeing lately the banks are kind of harping on?
I mean, like Jamie just said, if you're coming in, if you're buying a student housing deal from, say, a mom and pop owner who is running payroll FAT, for example, and running a few other expenses well above average and well above the comps that we have, we're okay underwriting a more normalized figure going forward, assuming we can get appraisal support for that and the borrower can show other assets, how they operate at lower expense line items going forward. There are some definite efficiencies there, and that's an easy pitch to us when we have a local person who maybe only owns 1 or 2 deals versus a Landmark, for example, that's one of the largest owner managers in the country who can show us a whole stack of comps. Like, no, this is how we need to be moving forward. So that's honestly the best, on an acquisition standpoint, the best way to get the most bang for your buck as far as juicing proceeds by getting us to underwrite lower expenses. There's not really, I don't anticipate on the debt side us any lenders leaning on future rents anytime soon. Not even some of the more aggressive relationship banks. I mean, we've just seen a real big pullback from a lot of the banks over the last 60 days based on a number of factors. The increased reserve requirements. They're not getting as many payoffs right now because there's not as many sales happening. So they're just not lending money. So it's very difficult to get construction financing right now until they start getting paid back off on those construction loans. They're not going to lend money back out. So that's what's really caused a reduction in liquidity in the banks. We focus a lot more on the Fannie Freddie side. We're about to, as Dave said, Borsto said on the previous thing, we're about to find out what the scorecard is for Fannie and Freddie, and that's going to hopefully give us our sort of caps on what we can do for 2023 in student housing. And so we're obviously hoping for a big number for next year.
Guys, thanks so much. I've got to get on to the next panel, but I certainly enjoyed this format. I don't know if we'll do this, like I said, every single month because it may be the same thing every single month. We may need to spread this out and do this format every quarter, but I really appreciate it. Thanks for the insight, and we'll talk to you soon.
Thanks everybody.
Thanks, everyone.
All right, let me go ahead and bring our next panel on. While I'm waiting for them to come up, I wanted to make a quick announcement in regards to LeaseCon TurnCon that is coming up December 6th and 7th in Charlotte, my backyard. So if you have not registered for this yet, make sure that you go over to studenthousingbusiness.com and you can find the link there. You can also find the link on our website at studenthousinginsight.com. If you go to our calendar area there, you'll see the event and have a link. Well, guys, I'm excited about this next panel. This is something that the leadership committee said a couple of months ago that they were really having some. Hold on a second, Nancy. We got to kick somebody off here in order to get her on. All right, there we go. But yeah, the leadership committee and myself sat down a couple of months ago to talk about some topics. And one thing that came up was what is going on with being able to recruit. The Great Resignation has happened. We've also got a lot of consolidation that's happening. And that is just, it's specifically in the student housing industry, that's causing a lot of issues with finding folks. So I wanted to bring a couple of folks on that work in that every day. They're all recruiters, a couple that are external, a couple that is internal. But really quick, I'll let you guys go ahead and introduce yourselves.
Sure, I'll start. My name is Nick Morris, and I'm the Director of Talent Acquisition here with Cardinal Group Companies.
Hi, I'm Nancy Giles. I am the owner of AAP Advisors, executive search, recruiting, specifically in the real estate space.
Hi guys, I am Stephanie Nolan. I am the owner and founder of SBC Professional Search. I have been recruiting for about 23 years and 13 of those years in student housing.
Oh, fantastic. Well, you guys definitely know the landscape. I've spoke with several or all of you guys over the past, certainly over the past decade when it came to finding folks in this industry, and all of you have done a fantastic job with it. But let's talk about this great resignation that's happened. I may have said great recession earlier, but I meant to say great resignation. It's strange to me how I could see how things were happening in 2020 and 2021, but now we're getting a little bit past the pandemic, and doesn't seem to really, it's not getting any better. And one way I know that is I look at this chart that came out from the Bureau of Labor Statistics, and I think a new one just came out yesterday. They're currently at 15.9% of the folks that were surveyed. There is the share of unemployed Americans who voluntarily left their jobs. And I just thought that number was pretty crazy. And then we've also got headlines like this. I mean, this was just back in July. Great Resignation shows no signs of slowing down. 40% of U.S. workers are considering quitting their jobs. Here's why they're going. So really, when you look at just the past 3 years, go back to to 2019, that landscape seems to really changed. So I wanted to find out, from you guys, kind of give some insight into that, some technical details into that, if you would, on what's different from 2019 versus today.
Sure, Wes. Well, when you think about it, the industry as a whole has been on a lightning trajectory with change, right? I mean, the development of ops tech really coming into play, and then you're looking at more diversified markets. Then you're also looking into just the sheer growth that's happened in the student space. I think what happened was when we started seeing a turn in expectations with the consolidation, which I think Jamie had mentioned earlier. You had a lot of folks who were really ready to start asking larger questions about their career within the space, right? So if you were to flash back 15 years ago, there we are doing paper leases, right? Filling it out in triplicate. Whereas today, through ops tech, those admin heavy institutional knowledge roles are not quite as much as they were, not there quite as much as they had been before. So, when you look at the overall trajectory within multifamily housing, when it comes to folks who are seeing a brighter and broader future, I don't think we've done as good of a story as telling what that can be through vertical integration or new services that are coming out. So I think what ended up happening was folks who were going to choose to stay in the industry were probably looking for more permanency around their roles, maybe moving to other companies, but also chasing the almighty dollar. We are coming up on what does look like it's going to be a recession, right? So people are trying to insulate themselves a little bit more. But I think trending forward, what we're seeing with the emerging workforce is a step away from sort of that culture and compensation sort of conversation. Right, where those were the two most important things. I think culture absolutely still lives on, but it's changed a little bit. So if we're looking deeper into the expectations that we're seeing now from applicants specifically to Cardinal, it's really around what job permanency will look like. Can they be upskilled in their roles? Can they be taught something new? Do they have potential to move either vertically or horizontally within an organization? They're looking much more closely at where the organization is going, where the ethos is. And of course, do they have representation? That's probably going to be the biggest theme of my world in particular. If we look at the sort of the changing landscape of the demographics within communities as they exist today and then going into tomorrow, we have to be a little bit more sensitive to being representative of those audiences that are coming in. And being responsive to it, essentially speaking the language. So I think, if we're looking back just 3 years, the conversation shifted, again, around compensation and culture. I'd also argue there's a lot to be said about relocation, whether or not somebody has a tolerance to be working remotely or whether they're open to moving markets to be able to further their career. But I'm very interested to see what happens over the next 5 years as the industry continues to mature.
Yeah, I could pipe in on this a little bit because I had an interesting conversation this morning with an individual that.
Be careful there, Nancy. Don't give any names out.
I'm not. That actually grew up, as so many student housing professionals do, grew up, in the industry, started as a CA, et cetera. Worked the last probably 5 or 6 years as a property manager on a property. Same market, has never been outside of that market. And I noticed that he just made a move recently, completely out of student housing. Mm-hmm. So I gave him a call to find out, since we were talking about this the other day, I gave him a call to find out exactly why he decided to make that decision. And, the conversation was that off-campus climate, from his perspective, has changed significantly, over the last few years. All the craziness around COVID has had a hugely difficult time finding solid employees, especially maintenance, which, I think we're going to touch on later in the conversation. Again, just like what we were talking about, a trend towards everyone wants to work remotely. They don't want to come into the office, onto the property anymore. And as the property manager, then he was filling in on so many different roles. There just was not that work-life balance that he likes to keep anymore. He was having to do 3 different jobs. Lastly, he said that he just really wanted to feel a more purpose-driven or have a more purpose-driven role to make, more of an impact. He's staying in the student space, but he's not he's not as a property manager anymore. He's working on the university side. So I thought I thought those were interesting because they really kind of mirrored everything that we are assuming is happening in the industry, right?
Yeah. Interesting we get to the on-campus side because it's been an exodus from that side as well.
Yeah.
Stephanie, how about you? What are you doing different on a day-to-day basis versus 3 years ago?
I definitely agree with everything that Nick and Nancy touched on. The ability to work remotely or a hybrid work environment, I hear 99% of the time. But something else, I think, especially because of COVID, quarantine, childcare, things like that, benefits have become more and more important to a lot of people as well. I think across the board, most companies, had been offering sort of, more or less the same type of health plans. But I think people are really looking at those much more closely now, the cost, any perks that come with those, the parental leave. Hey, my child's daycare has been closed for 6 months. What do I do now? I have to quit my job. Or, my kid has had a fever for 3 weeks and I can't send him to school. What do I do? The benefits, parental leave packages. I think things like that people have been examining a little bit more closely as well.
Yeah. Well, it's funny because I've just launched a poll a little bit ago, and we've got some people that have answered. And, you and all of us talked about this in our pre-meeting that some folks from our leadership committee were saying, we basically survey our employees every single year, and compensation has always been one of those top 3 reasons they're thinking about making a change, or that they came to that particular company, but it's never been number 1. And now they're seeing it as number 1. And same thing here in our poll, compensation's coming in at 53%. So that's interesting. All of you guys also recruit for the conventional sector as well. So this is a question that our leadership committee had specifically. Are you seeing any differences between conventional and student housing? And if so, what is it?
Yeah. I work a lot on the conventional side as well as, working a ton on the student side. And the differences that I typically see are, I think it's easier to recruit from the conventional side. You're working with an older demographic. You're working, I think there's a much larger pool of candidates that you can go after when you're recruiting for the conventional side. If I run into any problems at all, it is usually the fact that if a client is requiring an individual to have a degree, that eliminates a lot of people right off the top. There are, when you think about it, years ago, when people got into property management, they didn't go into college saying, hey, I want to get a degree in property management. They didn't exist. That degree didn't exist. So people that have, 25, 30 years of experience on the property management side, they fell into it somehow. And a lot of them don't have a 4-year college degree and have never felt the need to go back and get that. So that's really the biggest stumbling block I run into.
Yeah, and I definitely agree with that, Nancy. And I think also it is easier to find candidates or to place candidates in the multifamily sector, because in student housing there are so many specific skills that need to be learned, whether it's just, the lease terms are different, turn, of course. I think that's the biggest thing that multifamily managers, if they make the transition to students, turn is always where they fall or where they fail. There's just too many specifics in student housing that makes it a little bit more difficult to find people.
Yeah.
So to get from an internal perspective, I mean, you guys have you're mostly student housing at Cardinal, but you've got a good portion, at least out west, where you're doing a lot of conventional.
Right. Yeah, both in the conventional and affordable space. And there's an old joke really in our industry, and it's, how do you compare those worlds? Well, student is everybody's parent is an attorney. In conventional, everybody is an attorney. And of course, in affordable, everybody has an attorney, right? So, when you think about kind of what that means in a larger context, I think the roles that exist now in all three verticals are fairly similar by their own nature. And really, really wholeheartedly agree here with Nancy. The expectation that we have somebody coming into a role either on maintenance or into a manager's chair, that they have a certain level of education that would be more commensurate with, call it an asset manager, I think doesn't hold as much water anymore.
Yeah.
Again, we're talking about a big shift in the industry over the last 5 years. You think about a leasing agent today. 5 years ago, they were in high school, right? And they are way more sophisticated, I think, than we give them credit for. So, when you think about that division, I would argue the successful candidate of tomorrow isn't the one that has the pedigree of yesterday, but rather is somebody who can engage with and support and be responsible for residents. Creating that unique living experience, because really that's the only thing across student, across conventional, across affordable, that's going to make a community profitable, is that level of attraction engagement.
Yeah. Hey, we're at the top of the hour, and I've got I want to get to some comments that we've had here in the chat, and kind of ask you guys specifically, because we're talking about maintenance being the hardest ones to recruit for. Any suggestions on that specific position or those positions on the maintenance team on site, as well as from a area regional type of maintenance director? Any, you don't have to give your secrets away, but any kind of common themes or anything that you're seeing there that might help these audience members in recruiting those folks?
Well, I was looking for a way to respond to Greta's comment. I 1000% agree that the maintenance is the most underappreciated person on the property. I mean, everything would fall apart without them, quite frankly. And I see a lot of companies offer bonuses to maintenance, and while others don't. Some offer housing on site for maintenance, and some don't. Just even those little things. If you're going to offer me maybe the same salary or $2 or $3 less per year, but give me a free apartment, or, hey, I'm working harder than anyone here, I deserve a bonus as well. I mean, there's a big shift between what's going to make someone, stay at their job or move on. And something else that I see also is the relationship that especially the maintenance supervisor has with their GM. If that is not a harmonious relationship, then that person is going to have a foot out the door on day one. I see that a lot, especially when there's, a GM change or a management change. I don't know if you guys are seeing that as well.
Yeah, I agree completely with what Greta is saying, and with what you just said, Steph. I have found that they just aren't. The industry is getting much better at this, but they're not considered part of the team a lot of times. And you would argue that some people could argue that they're probably the most important part of that team. And they're getting better at that. And I think changes have to be made in the industry to really, try to retain them in a lot of different ways. And I think being an integral part of the team is probably really important. Start there.
Yeah, and I agree. We recently ran a study looking back through the last 3 years of every maintenance applicant that we've had for every role, looking geographically, right? Where are they and where do they move? And what we found was it was greater than 60% of our applicants currently live within 100 miles of the first job that they listed on their resume. So we know these folks aren't moving around. Right, we know that this is a very centralized role. This isn't what we would see normally on the office sides, and I 1,000,000% agree here with Greta around the importance of the role in maintenance. So when you think about what their involvement is in the community, they save the day. They are the person that everybody on site knows. They know them by name, if not sight. They probably remember the name of the person that leased them the apartment, but they know the maintenance team. And what we've done a really poor job of, and again, I completely agree here with the panel, is recognizing that as a value, right? Because if somebody renews, you didn't spend money on vacancy, you didn't spend money on marketing dollars, you didn't spend money on payroll for leasing. So I think the missing piece here is showing an audience who we know is not going anywhere, is going to stay in a market and can easily jump ship for 50 cents more an hour. And do, to the tune of that 60%, that we have to engage them. We have to show them that through things like obtaining a CPO certification, now they're saving the community X amount of dollars, and that gives them a leverageable position, right? Or an EPA or a CPO certification. And I think we need to show them that the overall value that they provide to the community. So I absolutely agree too that housing should be part of the equation. We're asking these folks to be there on site and unlocking doors at God knows when in the night. But we also need to enable them to be able to save that day, right? To be able to provide that level of service to residents, whether that even just be a leaking hot water heater that now the resident knows that they're going to have a rough day at work the next day because they had to take a shower, right? We need to be engaging with them at a level to show them their own value, which then translates into that word of mouth that exists in those markets that we know that they're not leaving. So they can go to a person who they know or somebody they're acquainted with who is going to go to work for Carrier fixing, HVAC systems and say, look, I understand that you got your certification. If you worked for a company like mine, we would have paid for it. Yeah. I understand that you're making $100,000 a year, but you don't get any benefits along with it. You get a truck and your name on your shirt. We need to do a better job of showing that this is a viable career path for maintenance-minded people. And then, of course, as we're trending more towards centralization and more consolidation within the industry, I would argue that the maintenance teams are going to have a much larger role, not only in retention, but also attraction to the community. So if we can show them that as the world is contracting a bit just by nature of the business, that they have more agency in the overall success and therefore more opportunity.
Yeah. We had one other question here, and I know we're way over, but from Dina, she was talking about the benefits part of it, and specifically with childcare and that rising cost that's also happening because of inflation. Any suggestions that you guys have that maybe you guys have seen other companies do or
I don't know specifically about child care, but I've seen 2 or 3 times, maybe more than that, companies are offering things like free diapers for your child's first year. And about fell out of my chair when I saw that, like how beneficial that would be. I think 90% of your child's or an infant's first year, the cost goes to diapers. Yeah. Any little offset of cost that you could put aside for childcare or offering maybe a monthly stipend for childcare, even if it's just, $100. I mean, you get into sticky areas where, hey, I chose not to have kids. Why does, Nancy get this extra, $100 a month for her child and I don't get anything? But, again, just even things like the free diapers, I think that's amazing. Any kind of offset of cost would be a huge benefit, in my opinion.
Yeah, I don't see a whole lot going on in that area with the clients that I currently work with. A thought though would be, and I believe there is something like this. I'm not sure what the name of it is, but like an HSA, like a savings account through the company that comes right out of your paycheck. You contribute to it, and if you contribute to it, then the employer also kicks in a little bit. I think something like that would go a long way. And then you can pull from that money, you can pull from that account monthly, to pay your child care bills, or at least support it. Maybe companies can think about something like that.
Yeah, and one other just small comment. I think from an HR perspective, for a long time, really until quarantine, and we were really forced to look at it, companies have avoided, in general, they don't want to know if you have kids, how many kids you have, the legalities around it, but also, unfortunately, a lot of people think, great, how much work are you going to miss because you have kids? Yeah. And, Nick doesn't have kids, so we want to hire Nick. I think the more we break down the barriers and of having kids in general, our employees are parents. We need to acknowledge that. It's always kind of been a big elephant in the room. And if we can just get rid of that thinking in general, then I think that goes a long way as well.
Yeah. Normalize the conversation that it's okay to have a family.
Absolutely.
That it is okay to be a human being within our industry. And if you really look at what we do, again, we're not selling cars where people come back for a warranty claim. We live in people's families. We become part of their families. So why aren't we able to feel comfortable about having our own? So trends that I've seen that have been hugely successful. One was the flexible spending account. I think that's a wise move, especially pre-tax dollars. But really also looking at parental leave, flex time around parental leave, not just here's your maternity, paternity, but here's the bank of days or the bank of times. Use it as you wish, right, to be able to pivot around what you need to accomplish. But I also think partnerships through organizations like Care.com or Carrot, these institutions that have now been set up to service working people within the world, to be able to provide them relief, whether that's temporary care, whether that's family planning, right? We need to be able to normalize this conversation in a meaningful way, and then put the resources behind it. And I love that point about is it okay to leave my job for 3 months? Am I going to be gone afterwards? We need to ensure that anyone in this industry who's charged with taking care of other people and the people that they care about is in a position to come to work each day unencumbered by worrying about the people that they care about in themselves. So a lot of room in here to do it. And I'm looking forward, I think, to what legislation looks like over the next coming years, knowing that a large generation is, quote unquote, coming to age and having kids and entering the workforce. But I would anticipate a lot of that level of retention is going to be around enabling people in our industry to be able to have that life goal checked of having kids, creating a family.
Great. Guys, we needed to do another podcast on it because there's a lot of things I'd love to deep dive into that. So maybe we can put something together, but in the interest of time that we've already gone over, those of our audience members that stayed on this extra 13 minutes, thanks so much. But guys, thanks again. I look forward to having you guys on here. I'll make sure on the repost that we put each of your email addresses there. So if anybody's got any specific questions for you, they can ask it there. So thanks so much.
Thank you.
Thank you, guys.
Well, guys, thanks so much for sticking around. Please make sure that you tell your colleagues about this. We've had some great growth over the past 3 months. Want to keep that going. You can send them to shoptalk.info and they can register there. The next Shop Talk is going to be Thursday, again on Thursday,
December 15th, 2022 at 1 p.m. Eastern. If you've got any questions, comments, things you want us to talk about on Shop Talk, please feel free to email me at contact@studenthousinginsight.com. Again, that's contact@studenthousinginsight.com. Thanks, everyone.
Thanks, Wes.